Welcome. This video is represented by Balwinder Teje, mortgage broker in Winnipeg. Today, we're diving into one of the most significant financial decisions you'll ever make, especially if you're looking to buy a home here in Canada, choosing between a fixed rate and a variable rate mortgage. It's a topic that can seem complicated, but I promise by the end of this video, you'll have a much clearer picture. So, what's the deal? A fixed rate mortgage, in simple terms, means your interest rate is locked in for the entire mortgage term, so your payments stay the same month after month, year after year. Think of it as predictability personified. On the flip side, we have the variable rate mortgage. With this option, your interest rate can fluctuate. It's usually tied to the lender's prime rate, which itself is influenced by the Bank of Canada's policy interest rate. So, if the prime rate goes up, your interest rate could go up, and if it goes down, you could see some savings. This means your payments might change, or the amount of principal you're paying off each month could change depending on your specific variable rate product. It's a bit more of a roller coaster, but it can sometimes come with lower starting rates. Now, I know what you're thinking. Which one is better for me? That's the million-dollar question, or rather, the several $100,000 question. In this video, we're going to break down the pros and cons of each type of mortgage in detail. We'll look at the stability of fixed rates, the potential savings of variable rates, the risks involved, and the penalties you might face. My goal here is to give you all the information you need to understand these options thoroughly, so you can feel confident when you make this crucial decision for your financial future in the Canadian housing market. Let's get into it. So let's kick things off with the fixed rate mortgage, a very popular choice for many Canadian homebuyers, and for good reason. The absolute biggest advantage, the headline feature if you will, is the predictability it offers. When you lock in a fixed interest rate for your mortgage term, typically ranging from 1 to 10 years, but most commonly 5 years in Canada, your principal and interest payments remain exactly the same for that entire period. This means no surprises when you look at your bank account each month for that mortgage debit. You know precisely what you owe and when you owe it. This consistency is incredibly valuable for budgeting. Think about it. Your mortgage is likely your largest single monthly expense. Knowing that this significant chunk of your outgoings won't suddenly jump up allows you to plan your other finances with much greater accuracy and peace of mind. You can allocate funds for savings, investments, utilities, groceries, and even those fun things in life without the nagging worry that a sudden interest rate hike might throw your entire budget into disarray. For first-time homebuyers or anyone on a relatively fixed income, this stability can be a massive stress reliever, making the journey of homeownership feel more manageable and secure. Furthermore, this predictability extends beyond just your monthly cash flow. It helps in long-term financial planning too. If you're setting goals, say for the next 5 years, perhaps saving for a child's education, planning a major renovation, or building up an emergency fund, knowing your core housing cost is stable makes those projections far more reliable. You're not guessing what your mortgage payment might be in 2 years, you know. This allows for more disciplined saving and investment strategies. As you're working with a known significant variable locked down, it's like having a solid foundation for your financial house. Another major selling point for fixed-rate mortgages, and one that's particularly appealing when there's economic uncertainty or talk of rising interest rates, is the protection they offer. When you have a fixed-rate mortgage, you are essentially insulated from any increases in the Bank of Canada's policy rate or the lender's prime rate during your term. If interest rates in the broader economy start to climb and you hear news reports about borrowing costs going up, you can sit back with a sense of security knowing your mortgage payment isn't going to budge. That rate you signed on for is your rate, period. This protection can be incredibly valuable, especially in a volatile interest rate environment. We've seen periods where rates have increased quite rapidly, and homeowners with variable rate mortgages might have experienced significant jumps in their payments or seen more of their payment go towards interest rather than principal. With a fixed rate, you avoid that stress and uncertainty. You're not anxiously watching every Bank of Canada announcement, wondering how it's going to impact your personal finances directly. This peace of mind is often cited by borrowers as a key reason for choosing a fixed rate. It's a premium they're willing to pay for stability. Imagine the scenario interest rates rise by 1, 2, or even 3% over a couple of years. For someone with a variable rate mortgage, That could mean hundreds or even thousands of extra dollars per year in interest payments, or a significantly longer amortization period if their payments are fixed, but the interest portion increases. For the fixed-rate mortgage holder, however, their financial situation regarding their mortgage remains unchanged. They continue making the same payment they budgeted for, allowing them to weather economic storms with greater ease. It's like having an insurance policy against interest rate hikes for the duration of your term. Now, while fixed-rate mortgages offer fantastic stability and peace of mind, it's not all sunshine and rainbows. There are some potential downsides you absolutely need to be aware of before you sign on that dotted line. Firstly, that comfort of a locked-in rate often comes at a price. Fixed interest rates can sometimes, though not always, start out a bit higher than the initial rates offered on variable rate mortgages. Lenders are essentially pricing in the risk that rates might fall, and they're also giving you the benefit of certainty, which has a value. So you might be paying a slight premium for that predictability from day one. Secondly, and this can be a tough pill to swallow, if interest rates in the market decrease significantly during your fixed term, you generally won't benefit from those lower rates. You're locked in. Imagine signing a 5-year fixed rate at 5%, and a year later, new mortgages are being offered at 3%. You'd still be paying that 5%, potentially missing out on substantial savings over the remaining years of your term. This can be frustrating, especially if you see friends or colleagues with variable rates enjoying lower payments. You're committed to your agreed-upon rate until your term is up for renewal, regardless of market movements. And perhaps the most significant downside, the one that catches many people by surprise, is the potentially hefty penalties for breaking your fixed-rate mortgage contract early. If you need to sell your home, refinance to a lower rate with a different lender, or pay off your mortgage ahead of schedule before your term ends, you could be hit with what's called an interest rate differential penalty. These IRD penalties can be substantial, sometimes amounting to tens of thousands of dollars, because the lender wants to be compensated for the interest income they'll lose. It's much more complex and often much more expensive than the typical 3 months interest penalty you might see with some variable rates. This lack of flexibility is a major consideration. Alright, let's switch gears and talk about the variable rate mortgage. The primary attraction here, the reason many Canadians opt for this route, is the potential for lower interest rates, especially at the outset. Often when you compare posted rates, you'll find that variable rates start off noticeably lower than fixed rates for a comparable term. This is because with a variable rate, you, the borrower, are taking on the risk of interest rate fluctuations, not the lender. Because the lender is passing that risk on to you, they can often offer a more attractive initial rate. So what does this mean in practical terms? Well, if that variable rate stays low or even drops further, you could end up paying significantly less interest over the life of your mortgage term compared to someone with a fixed rate mortgage who locked in at a higher rate. Imagine the Bank of Canada lowers its key interest rate multiple times. Each time the prime rate drops in response, your variable mortgage rate, which is typically prime minus or plus a certain percentage, would also decrease. This could lead to lower monthly payments, or if your payments are structured to stay the same, more of your payment would go towards paying down your principal balance, helping you build equity faster. Historically, there have been long periods where variable rate mortgage holders have come out ahead, paying less interest overall than their fixed rate counterparts. Of course, past performance is no guarantee of future results, especially in the world of interest rates. But the allure is definitely there. The chance to benefit directly if interest rates fall, leading to tangible savings. It's a bit of a gamble, banking on rates staying stable or declining, but for those comfortable with that uncertainty, the potential reward of lower borrowing costs can be very tempting and financially advantageous. Beyond the potential for lower rates, variable rate mortgages often come with another attractive feature: greater flexibility, particularly when it comes to penalties. If you need to break your variable rate mortgage early, maybe you're moving or you want to refinance, the penalty is usually much more straightforward and often less severe than with a fixed rate mortgage. Typically, you'd be looking at a penalty equivalent to 3 months interest. While not insignificant, this is generally far less financially painful than the interest rate differential penalties that can accompany fixed rate mortgages, which can run into many thousands of dollars. This can be a huge plus if your life circumstances are likely to change. Furthermore, many variable rate mortgages offer the option to convert to a fixed rate mortgage at any point during your term, often without a penalty, though you typically have to accept the lender's current fixed rates at the time of conversion. This can be a valuable safety net if you start with a variable rate to take advantage of potentially lower initial rates, but then the economic outlook changes or interest rates start to climb rapidly and you get nervous. You have an escape hatch. You can lock into a fixed rate for the remainder of your term, gaining that predictability you might suddenly crave. This blend of initial potential savings with an option for future stability is appealing to many. However, it's crucial to understand the significant downsides. The biggest one is the unpredictability of your payments, or at least the interest portion. If the prime rate goes up, your mortgage rate goes up. This could mean your monthly payments increase, sometimes substantially if you have an adjustable rate variable mortgage. If you have a variable rate mortgage with fixed payments, then as rates rise, more of your payment goes to interest and less to principal, meaning you're not building equity as quickly and your amortization period could actually extend. And even if rates are stable during your term, if they've risen significantly by the time you need to renew, you could be facing a much higher rate and payment for your next term, whether you stick with variable or switch to fixed. This unpredictability can be very stressful for some. So, we've laid out the pros and cons of both fixed rate and variable rate mortgages. The big question remains, which one is the right choice for you in Canada? And the honest answer, the one you might expect, is that it really, truly depends on your individual circumstances and financial personality and your outlook on where interest rates might be headed. There's no single best option that applies to everyone. The optimal choice is deeply personal and requires careful self-assessment. It's about matching the mortgage product to your life, not the other way around. Your current financial situation is paramount. Do you have a very stable income and a comfortable financial cushion? If so, you might be more willing and able to absorb potential increases that can come with a variable rate. On the other hand, if your budget is tight, or if you're a first-time home buyer still adjusting to home ownership costs, the predictability of a fixed-rate mortgage might be invaluable for your peace of mind and financial stability. You need to honestly assess how much financial uncertainty you can handle each month. Then, there's your risk tolerance. How comfortable are you with the idea that your mortgage payments could go up, potentially significantly? If the thought of that keeps you up at night, a fixed-rate mortgage, even if it starts slightly higher, might be worth the premium for the psychological comfort it provides. If you're more of a risk taker, or if you believe rates are likely to fall or stay low, then a variable rate might be more appealing. Also consider your expectations for interest rates, but be cautious here. Even the experts get it wrong. Trying to perfectly time the market is a risky game. The best approach is to choose a strategy that aligns with your long-term financial well-being and your ability to sleep at night. Alright, so that's a deep dive into fixed versus variable rate mortgages here in Canada. As you can see, there's a lot to consider. And the right answer truly isn't one size fits all. It really boils down to your personal financial picture, your income stability, your savings, your other debts, and your overall monthly budget. How much wiggle room do you have if payments were to unexpectedly increase with a variable rate? Or conversely, how much would you regret missing out on potential savings if rates dropped and you were locked into a higher fixed rate? These are critical questions to ask yourself. Equally important is your individual risk tolerance. Some people thrive on predictability and security, and for them, a fixed-rate mortgage is almost always going to be the more comfortable choice, allowing them to sleep soundly knowing their largest expense is locked in. Others are more comfortable with a degree of uncertainty, especially if it comes with the potential for greater financial reward in the form of lower interest payments. There's no judgment in either preference. It's about what aligns with your financial personality and your long-term goals for homeownership and wealth building. Ultimately, while I hope this video has given you a much clearer understanding of your options, the best course of action is to seek personalized advice. I strongly encourage you to sit down with a qualified independent mortgage advisor or broker. They can review your specific financial situation, discuss your risk tolerance in detail, explain the current market conditions and product offerings, and help you crunch the numbers to make an informed decision that's truly in your best interest. They do this every single day. Thanks so much for watching, guys. If you found this helpful, please smash that like button, subscribe for more content, and let me know in the comments which type of mortgage you're leaning towards or what your experience has been. See you in the next video.